This video is a review of Tokio Marine's financial results for the first quarter of fiscal year 2025, covering the period from April to June 2025. Tokio Marine, founded in 1879, is Japan's oldest insurance company and today a leading global insurance group. It operates in more than 40 countries and regions. Key messages. First quarter results are progressing steadily toward the fiscal 2025 projections. Adjusted net income excluding equity sales reached 33% of the full-year forecast, well above the initial pace, helped by the appreciation of the yen and strong international performance. Including capital gains from equity sales, progress was even higher at 45%, reflecting large sales of business-related equities. In Japan, property and casualty, auto and fire rate revisions are starting to show results, and another auto rate hike in October 2025 is expected to boost earnings further. Internationally, the main entities performed ahead of local plans, contributing about plus 28 billion yen in the first half. Despite these strong results, Tokio Marine chose not to revise full-year guidance yet, noting that currency impacts will offset over the full year and that the peak natural catastrophe season is still to come. Finally, equity sales of about 385 billion yen produced after-tax capital gains of roughly 266 billion yen, achieving 64% of the annual target, which is in line with the plan. Including one-off equity sales, the net profit progress rate is already at 50%, indicating very strong performance. Top-line performance. Net premiums written rose 4% year-on-year and 5% excluding currency effects, supported by rate hikes in Japan and strong international growth. Life insurance premiums increased 5% and 7%, excluding currency effects, in line with projections after last year's block reinsurance. In Japan, results were generally on plan due to auto and fire rate and product revisions. Internationally, solid underwriting and rate growth drove overall performance despite the expected impact of block reinsurance. Progress toward full-year projections for adjusted net income. In the first quarter, Japan Property and Casualty reached 50% of its target, Japan Life 37%, and International 26%. Overall, adjusted net income was 33% of the full-year goal, or 45% with equity sales, showing strong progress. Changes in adjusted net income compared with last year. Profits rose sharply, mainly because Tokio Marine sold a large amount of business-related equities and booked sizable capital gains. Even when excluding these one-off sales, earnings were higher than last year, reflecting the positive impact of exchange rates and the absence of the heavy hail damage that hurt results in the prior year. Japan P&C benefited from better auto and fire insurance profitability. Japan Life added stable growth, and the international business stayed broadly flat, but still supported overall earnings. Natural catastrophe impacts. Compared with last year, total catastrophe-related losses fell, but the picture was different by region. In Japan, costs were much lighter because the big hailstorm that struck Hyogo in the previous year was not repeated, which reduced claims significantly. Overseas, however, the situation was less favorable. The California wildfire caused a substantial hit to international business results. Overall, the balance was still better than the prior year, showing that domestic improvements outweighed the heavier losses from overseas disasters. Stock price. This chart over the past year shows the stock price in Japanese yen at 6,440 as of September 4th. This chart shows the stock price in US dollars at 42.79 as of September 3. Tokio Marine's stock price has been rising, just like other Japanese companies. Current PBR is 2.49 and PER is 13.2. Dividend yield is 3.26%. Compared with the past few years, similar to other leading Japanese companies, the stock appears expensive in terms of PBR and PER, but the dividend yield is higher, as the dividend amount has been steadily increasing. Conclusion. Tokio Marine's first quarter was strong, supported largely by equity sales. Favorable currency movements and solid underwriting both in Japan and abroad also helped increase profits. With net profit already reaching half of the annual plan, the company remains on track, although management has kept full-year guidance unchanged due to currency uncertainties and the peak natural catastrophe season still ahead.